In this episode, we are going to talk about time and price theory of Asia session. It's extremely important because when you look at markets at the wrong times, you view it with a very specific lens. And when the right time and high probability moves come, you miss your entries. So let's get into it. This model focuses on precise liquidity grabs and market structure shifts. It's simple, effective, and perfect for those who like working with clear rules. So let's jump right into the Asian session model. The first thing you want to do is start by marking out the time window from 8 p.m. to 10 p.m. New York time on your chart. This time window is very important because it sets the stage for the entire model and gives you the context of where price is building liquidity during the Asian session. Once you have that marked out, the next thing you want to do is identify your nearest liquidity levels on the 15-minute time frame. These levels are key because they represent where price is most likely to be drawn to before making any meaningful move. So you want to be very clear on where those highs and lows are now. Once price takes out that liquidity, that is your signal to shift your focus. And at that point, you immediately drop down to the 1-minute time frame because this is where you are going to refine your entry and look for confirmation. From there, you are waiting for a market structure shift with clear displacement. And this displacement should leave behind something like a fair value gap or an order block, because those are the areas where institutions have shown intent and where price is likely to react from. Once you have that confirmation, you can look to enter your trade directly from that fair value gap or order block, as both of these act as high probability entry zones after the structure has shifted for your risk management. You want to place your stop loss beyond the swing point that caused the market structure shift. This gives your trade enough room to breathe while still protecting your capital. And finally, for your take profit, you want to target the next opposing liquidity level, or you can use something like the negative 2.5 standard deviation as a more advanced target. So once you follow this process step by step, you'll have a very clean and structured approach to trading the Asian session. And now that we've covered the full model, let's move into some real examples to see how this actually plays out in live market conditions. Here we have the 15-minute chart of gold, Monday, September 16th, 2024, and the first thing we've done is mark out our time window from 8 p.m. to 10 p.m. New York time, because, as we discussed earlier, this is where the model begins to take shape. Along with that, we've also marked out the nearby 15-minute liquidity levels, and this is very important because these levels act as the magnets for price. So before anything else happens, we already know where price is most likely to move now as we watch price develop. You can clearly see that the market comes down and raids the sell-side liquidity, which was our initial point of interest. And once that liquidity is taken, the narrative begins to shift from that point. Instead of continuing lower, the market now starts looking towards the opposite side, which is the buy-side liquidity that we already had marked out. So this is where we prepare for execution. As soon as that sell-side liquidity is taken, we immediately drop down to the 1-minute time frame, because this is where we are going to refine our entry and look for confirmation. Now here on the 1-minute chart, you can see exactly what we were waiting for. The market goes through a change in state of delivery, and we get clear displacement to the upside, and this displacement leaves behind a high probability order block. Now the reason this is considered high probability is because we have a strong down close candle that takes out the sell stops, and then price immediately closes above it, which shows a clear shift in control from sellers to buyers. So once we have that confirmation, we don't just enter randomly, we wait for price to come back and retest that order block. And as soon as price taps back into that area, that is where we execute our trade. Our stop loss is placed below the swing low that caused the shift, giving the trade enough room while still keeping our risk controlled, and for our target, we are aiming for the opposing liquidity, which in this case is the buy-side liquidity, resting above now. In addition to the order block entry, you can also see that the market structure has shifted, and we even get an inversion fair value gap, which gives you another valid entry model if that's something you prefer. So whether you are using the order block, the fair value gap, or the inversion, the key idea remains the same. We are entering after liquidity is taken and structure has shifted. And as you can see, price moves very cleanly into the target. delivering exactly what we anticipated. So this is a complete example of how the Asian session model plays out from start to finish, from marking the time window, identifying liquidity, waiting for the sweep, dropping to a lower time frame, getting confirmation, and executing the trade. Now let's move on to another example and reinforce this even further. Here is the 15-minute chart of gold from September 17th. And just like before, the first thing we've done is mark out our time window and identify the nearby liquidity levels, because that gives us the overall context of what price is likely to do now. As you observe the chart, you can clearly see that price runs through the 15-minute buy-side liquidity, and once that happens, the narrative shifts again, because after taking buy stops, price is very likely to move toward the opposite side, which in this case is the nearby sell-side liquidity that we already have marked out. And you can see exactly that behavior. The market starts manipulating to the downside, targeting that sell-side liquidity. So just like the previous example, once that liquidity is taken or in the process of being taken, we shift down to the 1-minute time frame to refine our entry. Now here on the 1-minute chart, you can see that after the buy stops are taken, the market shows clear downside displacement, and this displacement leaves behind a fair value gap along with a rejection block. Now this is where we prepare for execution instead of entering immediately. We wait for price to retrace back into that rejection block, because that is the area where the market has already shown rejection and where we expect it to react again. And as soon as price taps back into that rejection block, that is where we take our short position for risk management. Your stop loss goes above the swing that caused the move. And for your target, we are aiming for the sell side, liquidity resting below. And as you can see, the market respects that rejection block very cleanly and continues moving down into the target. Another thing to notice here is how the negative 2.5 standard deviation lines up with our target, which gives additional confluence to the setup. So once again, this is the same process repeating itself. Liquidity is taken, structure shifts, we get displacement, we wait for a retracement into a key area, and then we execute toward the opposing liquidity. And when you follow this step by step, you can see how clean and consistent these moves actually are when the model is applied correctly. So that is the complete breakdown of the Asian session model and how you can apply it step by step in real market conditions. As you've seen from the examples, the goal here is not to overcomplicate things. It's simply to identify liquidity, wait for it to be taken, and then align yourself with the shift in order flow once you combine that with proper execution on the lower time frame, whether it's an order block, fair value gap, or a rejection block. You start getting very clean and repeatable setups. The key is patience and discipline. You don't want to force trades. You want to wait for the model to fully form and then execute with confidence. If you stay consistent with this and focus on following the process rather than chasing the market, you'll start to see how structured these moves actually are. If you found this helpful, make sure to like and subscribe, and I'll see you in the next one.